Hello, this is Aaron Wren. Welcome back to the podcast. Today, my special guest is Oren Cass. He is the founder and chief economist at American Compass, which I would describe as a think tank focused on reforming conservative economic thought. I'll let Oren describe what he thinks of it a bit later, how he thinks about it. There's a link to that in the show notes. Oren and I previously worked together at the Manhattan Institute. We also previously worked in consulting. He worked for Bain and Company, and he was the domestic policy lead for Mitt Romney's 2012 presidential campaign. And then lastly, I would be remiss if I did not point out he's also a monthly columnist for the Financial Times, which is my favorite newspaper in the world. So, Oren, thank you very much for joining me today.
Oh, thank you so much for having me. It's great to see you.
There's a big debate over the state of the economy, maybe about the state of the country. So there are a lot of populist voters who are very upset. They think things are bad. And this is mostly on the right, but there are plenty of people on sort of the populist left who've been arguing this for a long time too. Whereas if you look at the mainstream economists on sort of the center right and center left, they're basically arguing that things are basically great. Really, this economy is amazing. And the people complaining are complaining about vibes. You've probably heard the term vibe session.
Yes.
What is your take on what the reality is of the economy?
Well, I think a starting point is just to say that the reality of the economy is, in fact, whatever people perceive. The point of economics is to understand and make sense of the experience of real life, not to tell people that what they are experiencing is somehow wrong. And so I think just as a starting point in saying that economists get so wrong, we should see the task here as being to understand what it is that people are upset about and why, not to figure out how to sort of get through to them that they don't understand their own lives. I think a lot of the disconnect comes down, frankly, at the end of the day, to metrics and the ways that economists measure the economy, which do not actually do a good job of reflecting the experience that the typical household has. And you see this, I mean, first and foremost, just with concepts like, GDP and economic growth. I mean, I like GDP. I like growth. It is a useful thing to measure. It is certainly something we should pursue. But it's simply not the case that as long as GDP is going up, the typical household feels like it's doing better. You can have all sorts of ways in which those two things diverge. The same, frankly, then goes for inflation. And I think something that we get wrong a lot is assuming that our formal measure of inflation, the price level in the economy, is a good description of the actual cost of living, the pressure that a family feels on its budget. And just to give one example of this, economists, when they're measuring inflation, intentionally try to strip out quality. So if things are getting more expensive because they're also higher quality, that doesn't count as inflation. And that makes sense in a lot of ways if you're trying to measure the price level as a macroeconomist. If you're trying to understand what's happening to a family that needs to afford health insurance, telling them, hey, we know your health insurance premium is going through the roof, but don't worry, it's also much better healthcare, does nothing. does nothing to help them make ends meet. And so I think what you're seeing over time and frankly, for a period of decades now, and then really feeling extra salient with the inflation of the last few years, is that the basic math of a household budget just does not work out anymore. What you can earn working in a typical job does not support a family the way that it used to. And telling people, oh, but your car has so many more cool widgets in it, does not make up for that.
Yeah, it is. It does seem like I see data from legit people that not everything is going well. But I do think there is a sense in which things have gotten better. When I was growing up in the 1980s, I would say most people did not have air conditioning in their house, even then. Well, now air conditioning is practically ubiquitous. I mean, there's still a lot of people without air conditioning, but it's just massively more widespread than it used to be. And there are so many ways in which consumer amenities have essentially spread through society in ways that we could actually only have dreamed about when I was young. And yet I see that life expectancy is declining. That's big alarm bells to me when we're one of the rare countries in the world that has declining life expectancy. And I know somebody just came out with a study that claimed it was only the bottom 10% of the people in the country who are causing all of this. But that still wouldn't make me feel very good. And then there was just some research out from Harvard economist Raj Chetty showing that upward economic mobility for whites in the bottom 25% of the income distribution has actually declined a lot for people born between, I think it was 1978 and 1992. So it does seem there are actually hard indicators, not just people's perceptions, that there are some real problems in the economy, and yet there's a lot of denial about it. It's like that doesn't matter.
Yeah, well, and I think you touched on two important things there. One is the air conditioning point, and I think it's really important to be able to hold two ideas in our head at the same time, both that we do have all sorts of amenities that we didn't have before. We have air conditioners, we have computers, right? How should we value the incredible opportunity everybody has to log on to X and listen to us have this conversation, right? On the one hand, that's an incredible thing that did not used to exist. On the other hand, if you think about sort of, and as consultants, we can talk in terms of pie charts or even better stacked bars, because everybody knows a pie chart is the worst form of data visualization. If you actually were to sort of try to make a chart showing the kind of determinants of somebody's life satisfaction, of the trajectory of their life, of how they're feeling about how things are going, consumer amenities would be a piece of it. I don't mean to minimize that, but we should all ask honestly about our own lives. How much of the bar would that really be? I mean, I didn't have air conditioning growing up. I have some window air conditioning units now. Yeah, I like it better when I can turn the air conditioning on. But if I thought about like, how's my life going and how much of it is connected to the air conditioner, it's basically 0 point something %. And so I think we do a real disservice to people when we tell them, why are you just not more grateful about the air conditioning? I think what people are thinking about instead, and this is where something like, Raj Chetty and the mobility data becomes so interesting, is, okay, what has actually happened in the context of people's lives, in their communities? A really interesting example of this in my mind is what's called the big sort. The way that I know you've written about this, that geographically, we have, for all sorts of reasons, essentially sorted ourselves increasingly into communities where, among other things, all the elites live together in communities with other elites. And look, I'm not here to say like, what the really nice thing to have is some elites in your neighborhood. That's not quite the point. But there is a way in which a strong community depends on the cross-subsidization of human capital from those who have a lot to those who don't. And if you separate that out and you leave a lot of people in communities that don't have the support that they used to have, or comparable people would have had in communities in the past, there are all sorts of ways that that's going to feel like a much greater loss than your air conditioning is going to feel like a gain. And not only are economists not going to notice that or measure that, if anything, economists are going to compliment the big sort and say that this is efficient and we are helping everybody live where they want, even as the quality of life deteriorates for so many people.
I want to go through some of the complaints that other people have made about the economy and see what you think of them, because there are a number of people who've made essentially complaints about various aspects of what has happened over the last 20 to 30 years. One of them, this is a little bit of a meme, but it's the idea that a lot of our economy is fake. And so one of the guys who raised this point is the French intellectual Emmanuel Todd. And so in his new book, he basically says you have to adjust American GDP for how much of it is fake. And one of his examples is healthcare. So our per capita healthcare expenditures are greater than 50% higher than the next nearest country. At the same time, our life expectancy is declining, which is not happening in the rest of these. And even if you suggest that we have better healthcare in the United States, which is probably the case, is it really 50% better? Doesn't seem so. The Journal just had an article yesterday talking about how these Medicare Advantage companies are sending nurses on home healthcare visits for the sole purpose of creating diagnostic codes that create more reimbursements for them to the tune of something like 15 billion a year. There's no healthcare purpose to these visits whatsoever. They're strictly about billing more. It does seem like a good chunk of our healthcare expenditure is, yes, counted in GDP, and yet we're vastly overpaying for what we're getting relative to the rest of the world, drug prices in so many ways. And a lot of this activity, I don't know, it's not a majority, but certainly some of it is just flat out a scam. So is there any validity to this idea that some of the economy is fake in this way?
I think there definitely is. I think there are a few different categories that you can look at within that. So one is what you might call the churn. And I think a lot of what you just described falls into that category, which is people are creating excuses to do things that get recorded as productive activity and generate profit for themselves, even though there is no actual net social gain. And I certainly think you see a lot of that in healthcare. You could find examples in all sorts of sectors. I think a second problem we have is that there's a lot of essentially fake activity in financial markets. The financial sector is by some measure sort of the fastest growing sector of the economy and has over the medium term in recent decades. But it's not clear what it's actually doing for anybody. I mean, in theory, the reason we like robust financial markets is because they help bring capital to productive uses. And yet our financial sector is not doing that. It is doing it less than it used to. And so we have an enormous share of the talent and energy and capital in our economy going into activities that generate a lot of money for the people who have a lot of talent and capital. And that shows up often in various ways in GDP, but does nothing for the typical household. And then I think a third category that's really interesting is where you have essentially just negatives. So for me, sports gambling is a classic example of this, right? Sports gambling and its massive growth in the past few years shows up as GDP growth. If we hear this about, right, legalizing drugs generally, we should legalize marijuana because then we can, tax it and so forth. Well, legalized marijuana shows up as GDP growth. If we just, encourage people to build casinos everywhere, that would show up as GDP growth. And yet I think there's certainly a lot of people, it would certainly be my argument that not only is this not actually contributing to people's well-being, it's actively detracting from it. And the problem is here that the formal economic models that are being used to assess well-being assume that everybody is always a rational actor, allocating their resources as well as possible. And therefore, whatever does get produced and consumed must be valuable in proportion to what has been spent on it. If you recognize that is a wildly simplistic assumption and should not be used as a basis for assessing the quality of an economy, then everywhere you look, you see places where economists might be measuring things one way and people might be experiencing them a very different way.
Another thing that you hear about is the decline of competition resulting from industrial consolidation in the United States. One of the persons who's made this argument is the French economist Thomas Philippon. He wrote an entire book on this, and one of his examples is cell phone plans. We pay apparently a lot more for cell phone service in the United States than they do in Europe, and there are simply fewer competitors in the United States. So many industries are now de facto oligopolies, in some cases, quasi-monopolies. Matt Stoller has written a lot about monopolies, and he's come up with some very interesting examples of how private equity has essentially created monopolies in sectors none of us ever think about, ranging from cheerleading to, porta potty rentals, through various roll-ups and machinations there. Do you think a lack of competition and industrial consolidation is a major factor in what we're seeing?
I think the lack of competition is definitely a problem. I'm somewhat skeptical of some of the measures of sort of industrial consolidation in a lot of traditional industries. I think, the reality is that you can have perfectly healthy competitive markets with, a few large players in them, and the data that there's been sort of this dramatic increase in consolidation, I don't think is especially strong. What I do think you see, and this goes to Matt Stoller's point as well, is that in critical sectors of the economy, the basic model for how you generate a lot of profit is to monopolize something. And it's really interesting. This is, Peter Thiel's theory. If you read Zero to One, his basic argument is that the entire goal of an entrepreneur is to find a monopoly. And this actually makes sense in economic theory. It's one of the very funny things about economists is that their own theory tells you that in a competitive market, no one should actually be earning any excess profit. And yet we understand that, of course, exactly what everybody is out there doing is trying to earn excess profit. And we see excess profits all over the place. And yet we're not supposed to notice that must mean there's some problem in the competitive market. And so I think the two places you see this in particular, one, as you just highlighted with private equity, is in finance. And for me, the concern is less the porta potty market in a sense than that the way that the financial investors have found to make the most possible profit isn't to invest in building some new great business or to fund innovation. It's to roll up the porta potty sector. And all of that actual profit doesn't actually then go to some successful porta potty entrepreneur who's managed to corner the market. It goes to the private equity fund that rolled it up. And then you see the same thing in tech, where the basic model of tech and what venture capitalists are pursuing is finding some market that you could potentially monopolize, because if you succeed, the returns are so enormous. And this is the lesson of a Google, of a Facebook, of these kind of platform applications where, the amount of profit that a Google generates today is almost entirely from selling ads, right? There's nothing actually sort of innovative or even consumer facing about how they make their money. It's just because if you get to be Google, you are worth literally trillions of dollars from having cornered an ad market. And so if you're a venture capitalist, what do you want to invest in? It's not something that could be a good, healthy, innovative business in a competitive market. It's something that has a 1 in 1,000 chance of becoming the next Google. And not only is that a terrible way to allocate capital up front, it then fuels these horrendous arms races where, Uber versus Lyft is a great example of this, where you had, essentially a decade of just shoveling billions of dollars down the drain to try to corner the ride sharing market. Again, that's not a productive model of investment. It is a theory of investment that says, let's go build a monopoly somewhere. And what I think we need is a model of antitrust enforcement that recognizes you have to discourage that. You have to say, don't bother trying to build the next Google, that by which I don't mean innovative tech company. I mean sort of sloth-like monopolist. Don't think that that's what you're going to do, because if you try, we're going to break it up. That's just, we recognize that is not actually a productive place for all of the capital to be concentrating.
The other one people have complained about a lot is zero interest rate policy and all of the money printing we've had since the financial crash in 2007, along with bailouts. So we're 15 plus years of essentially having zero interest rates. Again, quantitative easing was the government printing tons and tons of money. And we did have a massive quantity of bailouts. We bailed out the entire financial sector in 2007, 2008. You can say we bailed out everybody during COVID. I mean, we bailed out the whole country. Does this constant bailout money printing model, has that introduced distortions that are affecting the things that you're seeing?
I think it does. If I can plug my own podcast. I just wrapped up an interview with Richard Werner, who developed the theory of quantitative easing. So check that out on the American Compass podcast next week. It was a fascinating conversation, and it focused on exactly what you just described, which is it's not just that we were printing money. In fact, some people would dispute that money printing is exactly what was going on, but it is that we were bailing everybody out, that we were essentially saying, well, because we can't afford to have the financial sector struggle like this, we'd better just make the financial sector whole. And I think that as a sort of set of incentives and commitments is horribly toxic, and goes back to, I guess I'm noticing how often I'm returning to this theme of our financial sector and financial markets just being fundamentally broken and not operating the way that you would want them to in a healthy capitalist system. I think the longer term kind of zero interest rate policy and focus on sort of fueling asset bubbles has been something that's been very costly. I mean, we've essentially adopted a model again that says you can generate a lot of profit without actually doing anything productive in the real economy. And there's this idea that, low interest rates promote growth, high interest rates discourage growth. It turns out that that's not actually quite right. Low interest rates encourage a lot of borrowing. Whether that borrowing is the kind that's going to promote growth is a very different question. High interest rates actually conversely can focus the mind quite effectively on making sure you can actually think of something productive to do with your money. So I think the zero interest rate model is something that again built on this economic idea that all uses of money, all economic activities are equally valuable. And if so, well, let's just sort of pour some kerosene on the market and see what happens. Whereas what we are slowly learning in instance after instance is that that's just not right. And we have to have some capacity to be more discerning about what is good economic activity and what is bad economic activity.
Yeah, I was in a kind of salon discussion about the future of the Rust Belt, and this one economist, made the point that, hey, look, we're not going to revive the Rust Belt because talent wants to be in New York City, and New York City is the most productive, and look at that. And my point was, New York City only exists because it's of bailouts. I mean, if we had let the financial sector go under in 2007, if all those companies had gone bankrupt, which they were all bankrupt, New York City would not be what it is today. That's for certain. I mean, and, again, New York City was bailed out in the 70s. And you basically have, a situation where these elite sectors of the economy constantly get bailed out. And so they're able to, essentially speculate at a very high level. And again, I don't think it's a good policy for America to let New York City go down the tubes. Maybe it was even good that we bailed out the financial sector, but it does seem to me there are favored sectors of the economy that are essentially backstopped by the taxpayer and everything that they do. And no surprise that capital has pooled and talent has pooled into those industries and into those locations. We saw it with Silicon Valley Bank, this bank out in California that was deeply tied to the tech industry. It went under because of bad interest rate management, and the FDIC came in and made every uninsured depositor whole. And this wasn't your grandma, right? It was all these tech companies in the Bay Area. And so the Bay Area is essentially underwritten, again, on the backs of bailouts. Main Street is not getting bailed out. The average Rust Belt city is not getting those level of bailouts. It just seems to me something like it is distorting where talent and capitals flow.
I think that's right. I also think it goes to this broader point about our sort of economic model that takes agglomeration to be always a good thing. That if we can have a couple of hyper-productive industries, and let's stipulate for a moment that finance and tech are hyper-productive. I don't think that's correct, but certainly they show up that way in the GDP accounts. Well, then the more people we can get concentrated in those people doing those things, the more growth we'll have. And QED, that's the best thing. There's a I don't remember the author. I always love referring to this economics paper that actually tried to sort of build a model of how much higher GDP would be if like everybody could move to San Francisco and New York. And it's like, I guess that's an interesting model. Even if you said just everybody who wants to could move to San Francisco and New York, with the caveat that by wants to, we mean that's where we've concentrated all of the economic activity. And one of the problems with this tech and finance-led economic model is not only is it not actually practical to try to concentrate everybody in a couple of places, nor does everybody want to live in those couple of places, but you also lose the diversification and the benefits of non-agglomeration, of actually diffusion, which is sort of the pattern on which the American economy developed so well for centuries. And so this also goes to this point about how can people feel like things are bad when the numbers are so good if you have an economic model that says, well, look, we have plenty of high paying jobs, but they are only this certain kind of job, and to take one you have to move to this place, and by the way, here's how much higher the rent is going to be in this place. The economists will say, well, look at that. That's great. Look at the higher earnings and the higher GDP. And people will say, this is terrible. This is not the life that I want at all.
What about trade? Trade deals, international trade. That's the big one that everybody talks about. Trump talks about it. Pat Buchanan talked about it. Ross Perot talked about it. What about trade?
Well, trade is a particular hobby horse of mine, and I think it's important to say, trade in theory is great, right? If you go back to the classical economic models, if we have higher levels of trade and there are all sorts of things that China can make more efficiently than we can, and there are all sorts of things we can make more efficiently than China can, and they specialize in one and we specialize in the other, and we send some boats across the ocean to send the stuff back and forth, there wouldn't be a problem there. The problem is that as trade has actually evolved in our global economy, that's not what happens at all. What we have happening instead is that other countries, and China is of course the biggest example of this, make tremendous amounts of stuff that we used to make for ourselves. So we offshored an enormous amount of manufacturing from the US to China. Nothing got offshored from China to the US, right? Actually, I like asking economists this, like, what's your favorite example of an industry that was offshored to the United States? Because if trade were actually working properly, that should happen. There should be all sorts of things that used to be made elsewhere that people said, actually, let's have that made in the United States instead. And it didn't.
Don't we export a lot of services to other
We
countries?
do export a lot of services. The services as a share of total trade, though, it's just not very high. So it is true that if you include services in the total trade balance, the trade deficit goes down. But our trade deficit in goods dwarfs our trade surplus in services. I think by something like 5-1 last time I looked. And so the net effect of all of this is not that we actually have high levels of trade that are making everybody better off. It's that we have the rest of the world making enormous amounts of stuff for us. And what we send back is not new stuff that we got to make here instead. We send back pieces of paper. Because of course they're not sending us all of these goods out of the goodness of their heart. They are sending it in return for financial assets. So the way that trade actually works is things that used to be made here get made in China. They get sent here, and we send back treasury bonds, for instance, pieces of paper that say the US government, and by extension the American people, will make something for you at some point in the future. Or we send back real estate. You, in return for these consumable goods you've sent us, you now own these parts of the country. Or we send back corporate equity. In fact, I believe now the majority of equity traded on US exchanges is held overseas. So you send us stuff that you made, we send you back actually control of our productive assets and their future profits. Now that exchange from the perspective of an economist looks like a very good one. The goal, after all, according to economists, is to consume as much as possible, ideally while doing as little work as possible. So we get lots of cheap stuff. We don't even have to do anything in return. That seems like a great idea. Obviously, at least in my mind, if you think about it from the perspective of somebody's well-being, which is not only tied to how much cheap stuff they have, but also their own job, the well-being of their community, This is not actually a good trade. And if you think about the long-term trajectory of the American economy, it's not a good trade. It both hurts us immediately because it hollows out our productive capacity, and it hurts us in the long term because we are committing our future wealth in return for our consumption today. And so I think, this is a pattern that really took off, particularly after the end of the Cold War. And it's the sort of thing that was a bad idea right from the start, but takes time to sort of compound and the effects to be felt. And by the 2010s, and certainly today, we are feeling them quite painfully.
Now, what you described is the same thing that people used to say about Japan in the 1980s. And, Japan bought Rockefeller Center for all this money. They bought Columbia Pictures and all of these things. And the truth is, this ended badly for Japan. I mean, Japan basically had a bubble that burst, and they still haven't really recovered from it. It looked like to be a pretty good deal for us, in essence, trade with Japan. They didn't take over our economy, and they sort of went into a funk. Why would we think the same thing's not going to happen to China as they've distorted their own economy in the name of this strategy?
Well, the same thing very well might happen to China. I'm not here to say that I think, Chinese economic policy is fantastic and is putting them on a phenomenal trajectory, though certainly so far it has served them quite well. But the question is what the consequences are for the U.S. and what has been going on with the U.S. vis-a-vis the rest of the world. Sort of started with Japan, then essentially transitioned to become a problem with China. But who the counterparty is and how well they're doing isn't the question. The question is what is happening to the U.S. as a result. And so I think one thing to say is that, what Japan was doing and had it continued would have been, already started to be and would have been very damaging to the U.S. China has done it for much longer and a much larger scale. And the last thing I think is really important to remember is that, Reagan today is celebrated on the right as this, free market hero. When he left office in 1989, the Cato Institute called him the worst protectionist since Herbert Hoover. When the U.S. auto industry was really on death's doorstep in the early 1980s, as floods of Japanese imports started to take over the market, the Reagan administration didn't just put tariffs on Japanese automakers. They actually negotiated an outright quota. The number of Japanese autos coming to the country simply would not rise. And the result of that is the entire Japanese auto sector that we now have in the American South. The fact that Toyota and Honda and Nissan and so forth are major American employers brought first their assembly plants, then their entire supply chains, then R&D to the United States. That was a direct result of Reagan administration policy saying, this is too damaging, we will not allow it. And by the way, for a long time, the Toyota Camry then had more American content than any other vehicle on American roads. The U.S. did the same thing with semiconductors, and one of the first really strong examples of effective industrial policy in the sort of modern era anyway was the efforts made to combat the Japanese rise as a dominant semiconductor maker. And that again was wildly successful and was right at the outset of the microprocessor era and Intel's dominance for a period of time. So I do think you're right that Japan demonstrates these things don't always work well for the country doing it, but I don't think the lesson for the U.S. is in any way that we should be any less worried as a result.
I could probably talk for another hour about all these problems that people are there, but I want to get the solutions because we're limited on time. But I do have one final question because no one has ever answered this. We always hear that it's not trade that caused job losses, it's technology and productivity improvements. And yes, maybe there were some jobs lost to trade, but the vast majority of manufacturing jobs in the U.S. that were lost to automation, technology investment, just flat out becoming more productive. Well, I read that when you add up the number of employees working on Apple products in China it's somewhere between 300,000 and 700,000. It varies by source. Hundreds of thousands of people, hundreds of thousands of jobs in China just making Apple products alone. Let's just say it's 400,000 for the sake of the argument. Are those 400,000 Apple jobs in China jobs that were lost due to trade, jobs that were lost due to technology and productivity improvements, or do they count in some third bucket that nobody ever tells us about?
Well, I guess I would put them in a third bucket in that they sort of represent I guess counterfactual isn't quite the right term. But if we were making those iPhones in the United States, we wouldn't be using 400,000 people to do it. We would have put much more capital into much more automation, and we would be using a lower number of higher paid and more productive workers. So there's no sort of one-to-one where each worker you see making something overseas would instead be a worker making something in the US. I think the right way to understand it, though, and this goes back to what I think is so wrong about this claim that, what's actually happened is productivity or automation, is that it's absolutely true that, we are always looking for and hopefully getting productivity gains in all sectors of the economy, and manufacturing is a great place to get it. But that's always been the case. If you look at annual productivity growth in the manufacturing sector, during the so-called kind of, golden era, kind of post-war period into the early 70s, we were getting productivity gains of upwards of 3% per year, meaning productivity was, quote, destroying half of the jobs in manufacturing in about 25 years. Now, why did we not see any decline in manufacturing jobs at all during that period? Because we responded by producing lots more stuff, right? So if you have 100 people in a factory, each of them can now make twice as much. One response is to lay off 50 people. The other response is to double your factory's output. And we were on a trajectory where the factory's output doubled, each worker could be paid twice as much. And so the productivity gains were entirely to the good. And in fact, output grew even faster than productivity growth in that period, which meant we were adding manufacturing workers, even with very high levels of increase in productivity and automation. If you look at the next period from the mid 70s to 2000, you see almost exactly the same rate of productivity growth, slightly lower growth in output. But as a result, you continue to see strong wage growth and pretty steady employment. If you fast forward to the 2000 to 2020 period, what happens? Productivity growth is basically exactly the same. So yes, we continue to get productivity growth. We continue to automate things, but not any differently than had happened in the past. What changed is output growth stopped. Instead of saying, this is great, we can continue to make more stuff, we said, actually, never mind, we're going to go make the stuff somewhere else. And so the productivity gains that we were getting, instead of translating into more good jobs, started to translate into significant job losses. And so there's a way to look at that and say, well, as you can see, it's the productivity gains that are reducing the demand for labor. But I think that's a totally unfair analysis, because the question is compared to what? And you always want to have productivity gains in any sector. That's how wages and prosperity can rise. The question is whether you also have output rising. And it's our trade policy, not anything to do with technology or automation, that saw the demand for what American workers could produce fall off a cliff. And that's what has been driving the problems that we've had.
All right. Easy to talk about problems, hard to talk about solutions. What do you think we ought to do? What are your sort of top policy prescriptions?
Well, I think it falls, generally speaking, into two buckets. One is the kind of top-down macro picture of what's going on in the economy. And one is the kind of more bottom-up micro view of what's actually happening to families and communities. And so from the top down, at American Compass, what we focus on is the idea of what we call productive markets, which, as the term implies, highlights the fact that markets are not necessarily productive. That as we've been talking about through all these different parts of the conversation, there are lots of ways in an economy to generate lots of profit and do lots of activity that isn't actually productive at all. And if you actually want to have well-functioning markets, if you actually want capitalism to work for most people, you have to have the right set of rules and constraints in place so that the things that are going to generate a lot of profit are productive things that are good for the broader society. And so you can kind of apply that lens to all of these things we've been talking about. So the problem in the trade context has been that we've said, actually, if the most profitable thing for you to do as a manufacturer is offshore all your production, then that's great. You should do that. And we can't allow that. We have to say, actually, no, we need to make it so that it is more profitable to build productive capacity in the US than to offshore it. And that's where all the discussion today about tariffs comes in. I don't think tariffs is the entire solution, but putting a thumb on the scale and saying, actually, we are going to have a preference for things produced here over things imported, I think is an incredibly important policy move. I think likewise, we have to really discourage investment overseas and say, no, we actually want to see you earning your profit on investment here in the United States. And then we need what's typically called industrial policy, which is actual active efforts to make it more attractive to invest here. And this is what you're seeing with what's called the CHIPS Act in the semiconductor industry, is recognizing we actually want to be a leader in producing semiconductors, especially given the policies a lot of other countries are pursuing. Nobody wants to build an advanced semiconductor manufacturing plant in the US. So we are actually going to have to create incentives if we want both Intel and then foreign companies like Taiwan Semiconductor, like Samsung, to come build here. And so all of that is part of making productive domestic investment a more attractive way to generate a profit. And then on the flip side, with everything we've been talking about in financial markets, we need to discourage the kind of financial speculation that is so unproductive. And so I think we need a lot more financial regulation, not of the kinds that sort of, tells banks exactly what they can and can't do in this and that way, but of the kind that recognizes that just because you're doing something in a financial market doesn't mean you're being productive. So for instance, we support a financial transaction tax to discourage the sort of just, rapid trading and, get your trading desk a few feet closer to the trading floor so your trade gets in a few milliseconds sooner. That's not useful. There's no reason we should be supporting or even allowing that in our financial markets. Likewise, a lot of what's going on with private equity, with hedge funds, those kinds of investments, we need to have both a tax system and regulations that recognize that financial market activity that actually deploys real investment in the real world is great and needs to be encouraged. Financial activity that's just trading assets around in circles is not only not great, it's actively destructive and needs to be discouraged. So that's the productive market side. We can talk about the community side also.
We'll talk about the community side in a minute. I want to just challenge on one thing here. So Brazil tried something like this. Brazil passed a bunch of laws that basically required things to be produced domestically. So one of them was computers. Basically, Brazil banned the import of computers. And the idea is we need to produce these things domestically. So when I was at Accenture, when we wanted to procure computers for our staff, Brazil was always a special thing because it had to be special Brazilian-made computers. But in fact, Brazil never created any industries through that approach which were competitive at all. And it didn't make Brazil a prosperous country. Basically, if you don't have the scale to compete on a global basis, just creating a protected domestic industry, it's just going to be this thing that's just going to consume subsidies forever and be inefficient. Like, how would we create like an industry here that doesn't just essentially supply the domestic market due to some type of protection that we have, but is able to actually be, cost competitive and product competitive on a global basis?
Well, I think the first thing to say is that the US actually has a proven track record of being able to do all of this. I mean, virtually every advanced technology that is now being produced mainly overseas was pioneered and the production initially developed in the United States. And so if you were to say, what are Brazil's prospects for being a leading edge semiconductor manufacturer? I think one might fairly say I'm not sure why you'd believe they could do that. There's no reason to ask that question about the US. The US obviously can do that. And the reason that production left was not because the US wasn't good at it. It was because other countries started throwing massive subsidies at producers, right? There's in trade, people talk about the concept of comparative advantage, that different countries have things they're sort of naturally better suited to producing. There's no comparative advantage in semiconductor manufacturing, certainly not one that would say that like rocky outcroppings off the coast of China are the best place in the world to produce the most advanced semiconductors. That production only went there because of government policy. And so it doesn't make any sense, I think, to say if you're the US, well, we have either this principled view on free trade, or for some reason, we're going to look at Brazil or Argentina and think, well, they can't become world leading producers of things, so we shouldn't try either. I think we have to be a lot more pragmatic and recognize we can do these things. We have done these things, and we need to do them again. And the last thing I would say about it is that the model that you're describing for Brazil, the sort of absolute, you must make this here. I think with very narrow exceptions for national security is almost never the right approach. What you want to be doing is essentially putting constraints on the markets that force investors, that force producers to take into consideration the fact that we actually care that things be made in the US. And so if you put tariffs in place as an example, so that it's relatively more attractive to produce in the US, that doesn't mean that everything's going to be produced in the US. That just means that at the margin, some more things are going to be produced in the US. And if it turns out that none of the best computer assemblers are in the US, you're still going to be able to buy your computer from abroad. But if you're a company that's thinking, actually, I bet we could assemble computers well in the US, you're basically going to get a 10% price advantage for doing so. And so I think it is in a sense a policy that's very respectful of and serious about everything we know and love about markets. It just recognizes that markets aren't perfect, and in particular, markets could not care less where something gets made. So if, as a nation, we do care, we do have to have some sort of intervention to that effect.
Well, what about your policies at the community level?
So I think on the community side, it's really important to recognize this is actually something that conservatives have generally been very focused on, at least rhetorically, right? Conservatives always talk about the importance of community, of family, and so forth. It's only when the rubber then meets the road of actual policy, of actual thinking about the economy, that we suddenly abandon that and treat, every person as just sort of an efficient widget that can be thrown into the market. We have to recognize that for people to actually, succeed in a market economy, they are dependent on all sorts of support, on all sorts of institutions to actually be successful. One of those, I would say the most important one is the family. And we actually need to have many more policies in place that again, essentially put a finger on the scale for families and recognize that as a uniquely valuable and important activity and thing worthy of support. I think we need an education system that's focused much less on either we get you a college degree or we have nothing for you. Ideally, we would almost do the opposite and say, if you want to get a college degree, that's great. And frankly, we're less concerned about what's going to happen if you are able to earn a college degree. We're most concerned about the people who, still the majority of young Americans, who don't earn a college degree, and what sorts of pathways do we offer them to actually connect to productive work that is going to become a good career. And then the last thing that I think is really interesting to think about is the labor movement. And I have no shortage of objections to the way big labor operates in the United States today. Certainly, I am not a fan of public sector labor unions as they operate. But the idea of labor, the idea that you should want workers to have organizations that represent them, that give them power in the market, I think is an incredibly important and constructive one. And it's important to realize that the U.S. model is a quite odd one and an outlier. There are many other ways to do labor. There are ways that work better. And so for conservatives, I think it's really important to focus on that. How do we make this work better instead of what has been the case for a while, which is basically how do we just sort of cheer on its demise?
Yeah. When it comes to the focus on people without a college degree, if you look at the data, it's basically overwhelming that education level, particularly college degree attainment, is the most determinant factor in economic outcomes. Particularly, just job creation, but especially your income. I think it was Harvard economist Ed Glazer who pointed out that the number one determinant variable of variance in incomes between regions is the share of people with college degrees. And all throughout our past, we've constantly invested in increasing the education and skills of our workers through the high school movement, through massive investments in higher education after World War II. And yes, there are people who just are not going to be able to go to college. They don't have the intellectual capacity, perhaps. There are going to be people who are going to make good livings as an electrician or a plumber or some kind of skilled labor. Great. But isn't the way to become a more productive, higher income society to invest more in higher education and not less in higher education?
I think there was a time when that argument was sensible. To your point, we had so much success with the high school movement. The sort of next frontier being, all right, well now, how do we get everybody a college degree? Seemed like a worthy goal. I think it's really important, though, to recognize that we've been trying to do that for 40 or 50 years, and it simply has not worked. The increases in educational attainment sort of coming out of high school in terms of people who seem to be prepared to do college level work are not there. We are not improving our ability to prepare people for college. And we're not even producing all that many more college graduates, especially, if you go back as far as the 60s and 70s, you see a significant uptick in women who in the past might not have gone to college, even though they would have done very well, who then started to go. If you look at men, you see actually a very small change in the share that's earning a college degree over generations now. What we are doing is we are putting a lot more people into college. Right? You can always drop your standards and let more people in, but that is not translating into a society in which most people actually come out with college degrees. And we're also seeing that in outcomes for those who do earn college degrees. I mean, the Federal Reserve Bank of New York tracks what they call underemployment, which is what share of people who do earn a college degree then go on to a job that seems to require one. And for decades now, we've had, roughly 40+% of college graduates don't even then go on to a job that uses that degree. Even 10 years later, you've got, maybe a third who are not in a job that uses that degree. So what every signal is telling us is that we have reached the point of diminishing marginal returns, if not outright negative returns on the share of people that we are trying to push through college. And conversely, what we are seeing is enormous unfilled opportunities in jobs that don't require college degrees, right? As that underemployment data indicates, the share of jobs that don't require a college degree is still much higher. And part of the reason that I think the data can be a little bit misleading when we see how much better the outcomes are for people who do have a college degree is, of course, that's the only thing we offer, right? We're comparing the pathway where we put all of our resources and do everything we can to support people to a pathway that has nothing. And so I think it's very instructive to look at, again, the rest of the developed world, from which we are an extraordinary outlier in our attempt to push everybody through college. Other advanced economies, Western democracies, have very robust, well-developed vocational pathways that are actually real pathways, not just for people for people who have fallen off the real pathway, which is the college pathway, but that recognize that college is something that's going to make sense for some people, and it's something that's not going to make sense for a lot of people, either because of aptitude or because of desire, the kind of work they want to do. And so I think if we hold ourselves accountable for actually constructing pathways that say, look, we can get somebody, that is starting to earn on the job experience by the end of high school, maybe has a couple of years of subsidized on the job training, apprenticeship style work arrangement, get them to age 20 with, actual skills, job experience, money in the bank instead of debt, already multiple years into a career. That is going to be a preferable outcome for most people over what we are able to offer them with our suggestion that everybody just go to college. And by the way, the reality is that almost all Americans understand this. I think there's a very funny gap here between the sort of elite consensus that either everybody should go to college or else, well, we can't say anything else because that would be elitist or offensive. And if you actually ask American people what they think, we've done a lot of survey research on this at American Compass. The most lopsided survey result we have ever gotten is on the question of tracking. Particularly among middle-class Americans, the split was roughly 95% to 5% in favor of high school tracking. And we tried using the word tracking versus the term diverse pathways. Didn't matter. Overwhelming recognition that people need to be on different pathways and supported in going in different directions. And we even asked parents whether they would rather have their kid offered a 3-year apprenticeship that's going to lead to a good paying job or a free ride at any college they can get into. And most parents will choose the 3-year apprenticeship.
Well, I could talk about this for literally another 2-3 hours. I'm not joking. I got so many questions and so much. Well, unfortunately, we're out of time. So I want to wrap us up on time. But again, Oren Cass is the founder and chief economist at American Compass. Oren, thank you so much for joining me today.
Oh, this was so much fun. We will make it a home and home. We'll have you on the American Compass podcast soon. And let's do this again sometime as well.
Okay, great. Thanks so much.